All right, let's jump right in because today in this explainer, we're tackling what just might be the single biggest financial mystery in the market right now. We're putting Caterpillar, yes, the heavy machinery titan, under the microscope. Look, I was digging through their recent numbers, and there is just a massive, glaring disconnect here. We've got this unbelievable contradiction between what the company is actually achieving on paper and how the market is treating them. And honestly, we've got to figure this out.
Okay, let's dive into this. $20.5 billion. That's how much revenue Caterpillar pulled in during the second quarter of 2026, in one single quarter. They have literally never hit that threshold before in their entire history. It's a massive 24% jump. But it's not just the top line. Profit per share hit $7.77, and adjusted earnings per share reached an incredible $8.17. Plus, they generated $4.4 billion in enterprise operating cash flow. And if all that wasn't enough to make you do a double take, management looked at this war chest and decided to bump up the quarterly dividend by 8%, taking it to a very healthy $1.63 a share.
But here's the twist. Despite all those unbelievable, record-shattering numbers, the stock actually took a hit. On the exact day these historic, blowout results were announced, the stock dropped $22.74. That's a decline of almost 2.75%. And you know what? This actually isn't the first time we've seen investors seriously question Caterpillar's valuation right when their performance is absolutely stellar. So we really have to ask ourselves, what gives? What exactly is the market seeing that the casual observer is just completely missing? Are they entering the strongest industrial cycle we've seen in decades? Are we watching the start of an absolute boom fueled by new tech? Or are investors looking at this and thinking the absolute best-case scenario is already 100% baked into the stock price? Those two possibilities lead to vastly different investment choices. So let's start the investigation. Suspect number one in our investigation, the business operations. To really crack this case, we first need to get a grip on what Caterpillar actually does these days. Most of us just picture those iconic yellow machines, right? The excavators, the bulldozers, the massive mining trucks, but that's really just scratching the surface. They actually operate through several distinct machinery segments: construction industries, resource industries, power and energy, alongside a financial products division. And this matters a lot. Why? Because Caterpillar isn't just relying on one single economic engine. Construction drives one part of demand, mining drives another, and energy drives yet another. They are deeply diversified across the entire physical economy. And this brilliantly illustrates a totally unexpected angle for the company right now. We all know artificial intelligence needs microchips. But guess what else it needs? Massive physical build-outs. It needs crazy amounts of electricity, heavy-duty generators, power infrastructure, facility cooling, and the actual construction of these giant data centers. Caterpillar supplies the heavy equipment for parts of this exact build-out. Their recent numbers showed super strong demand in construction and power and energy specifically because of data centers. Meaning, completely under the radar, Caterpillar is actually acting as a huge AI infrastructure enabler. Crazy, right? Suspect number two, the profit machine. Let's follow the money. When you stack up Q2 2025 against Q2 2026, you realize profitability isn't just growing, it's accelerating way faster than their sales are. Their operating margin jumped from 17.3% to an incredible 20.9%. That is a massive 3.6 percentage point improvement, which is huge in this industry. How they do it? Well, revenue went up thanks to $3.1 billion in higher sales volume, sure. But they also got a $595 million boost purely from favorable pricing realization. In plain English, they aren't just selling more machines, they're successfully charging a premium for them. Now, what's genuinely staggering here is their backlog. $72 billion. Just wrap your head around that for a second. Imagine a company having $72 billion worth of work just sitting there, waiting in line to be fulfilled. That's a sequential jump of about $9 billion, and roughly $35 billion more than where they were just 1 year ago. Caterpillar isn't out there trying to magically drum up new demand from nothing. They've already got these orders locked in the book. That gives them incredible, crystal clear visibility into their near-term profits. Okay, so let's take a step back and look at the whole board here. If the revenue is up, profits are soaring, margins are expanding, and the backlog is literally bursting at the seams, what could possibly be wrong? Why on earth is the stock dropping in the face of all this undeniable textbook success? That brings us to Section 3, the real culprit: cycle and expectations. To really understand this dropping stock price, we actually have to look away from the balance sheet for a minute.
We have to remember that Caterpillar is not your typical secular growth tech stock where demand just goes up and up forever in a straight line. No, it's what we call a cyclical growth and cash return company. They operate in industries like mining, energy, and infrastructure, and those are inherently cyclical. When commodity prices are sky high and infrastructure spending is booming, companies buy equipment like crazy. But the second that economic cycle turns, equipment orders can fall off a cliff.
Now, to offset that roller coaster, Caterpillar runs a massive shareholder return machine. Just in the second quarter alone, they poured $1.5 billion into share repurchases and another $700 million into dividends. That's $2.2 billion handed right back to shareholders in a single quarter, completely fueled by that massive $4.4 billion in operating cash flow we talked about. Basically, they have the cash to aggressively reward investors right now while times are good. But right here is the ultimate hurdle and the real core reason the stock dropped. A great company can actually be a really tricky investment if you pay too much for it at the wrong time in the cycle. The people buying Caterpillar today, they aren't buying the company from 5 years ago. They are buying the massive, sky-high expectations currently surrounding the company. To keep the stock moving up, Caterpillar doesn't just need to perform well. They need to perform significantly better than investors already expect them to. The bar isn't just high, it's practically in orbit.
And here's where it gets dangerous. If the broader market decides that Caterpillar's current earnings are closer to a cyclical peak rather than a permanent ongoing baseline, we start seeing something called multiple compression. This is a phenomenon where a company's earnings stay incredibly strong, but the stock falls anyway. Why? Because investors are suddenly willing to pay less for each dollar of future earnings. They're effectively pricing in the future risk that this industrial cycle is going to peak and eventually slow down. Section 4. Weighing the evidence. Let's compare the two sides. So, how do we make sense of this whole puzzle? Well, on the bull side, the optimistic view, you've got record revenue, that really exciting AI data center exposure, a massive $72 billion backlog providing a huge safety net, and 32 consecutive years of rising dividends. But then you look at the bear case, the pessimistic side. You have the very real threat of a peaking industrial cycle, the looming danger of multiple compression, and the stubborn reality of global tariff and supply chain costs. Remember that pricing power we mentioned earlier? If customers finally start pushing back on those higher prices, tariffs and costs could absolutely crush those beautiful profit margins.
Oh, and there's a secret weapon we have to factor in here, one that beginners almost always miss: Cat Financial. Caterpillar doesn't just build and sell machines, they finance them too. In Q2, this financing arm generated $991 million in revenue. That's up 10%, with profit jumping to $145 million. And past due balances actually improved to 1.31%. This financing division is brilliant because it supports the core business, making it way easier for customers to buy. But it definitely introduces a layer of credit risk. If the global economy tightens up and customers can't pay their loans, this financing arm is going to feel the pain very quickly.
Which finally brings us to Section 5, the verdict. Let's wrap up this investigation.
We've laid out all the clues, so what's the actual takeaway for you? Well, it entirely depends on your personal investing style. If you're a beginner or a conservative dividend investor, the verdict here is largely a hold or accumulate gradually. You can sit back, enjoy those 32 years of dividend increases, and not stress about chasing a massive rally. Now, if you're a value or growth investor, this is a strict watch. Valuation is absolutely critical right now. A phenomenal company can still be a terrible entry point if the price is just too high. And if you're a high-risk momentum investor, please proceed with caution. That recent stock drop might not just be simple profit-taking. You need to watch like a hawk to see if this is the start of that dreaded multiple compression we talked about. To help you cut through all the daily noise and stock market panic, here is your action plan. These are the 5 critical numbers you literally must watch every quarter to know where Caterpillar is actually heading. 1. Revenue. Is growth still beating those sky-high expectations? 2. Operating margin. Can they maintain these elevated levels, or are costs going to catch up? 3. Backlog. Is that $72 billion cushion still growing? 4. New orders. Are customers actually placing fresh orders beyond what's already in the backlog? And 5. Free cash flow. Can they keep funding those massive dividend hikes and buybacks without hurting the balance sheet?
Now, out of all those metrics, there is one that absolutely stands above the rest. So the crucial point to remember is this. The ultimate indicator of tomorrow's success is new orders. Think about it. Revenue, that just tells us what Caterpillar successfully sold yesterday. The backlog, that tells us what they've sold for today. But new orders tell us exactly what investors are going to be buying tomorrow. If those new orders start falling off after the current backlog clears out, the market is going to look 6 to 12 months into the future and aggressively reprice the stock downward. So, I'm going to leave you with this final provocative thought to mull over. Cat hold, watch the orders. You've got to keep your eyes on the horizon, not just the rearview mirror. What happens when the cycle finally turns? Thank you so much for joining me on this explainer. I really hope we brought some clarity to this massive financial mystery today. Keep digging into those numbers, and as always, keep learning.